Welcome to Exponential Finance, the podcast that decodes the future of money. While the main stage at WebX Tokyo buzzes with talk of billion-dollar ETFs and institutional adoption, there's another, shadow economy at play, one that operates on the very same rails we're trying to build. Hacks, scams, sanctions, it's a multi-billion-dollar problem. Just last year, over $41 billion in on-chain value was transferred to illicit addresses. So, how do we build a transparent, trustworthy financial system on a technology that's so often associated with the shadows? How do you police a borderless world? To answer that, we have the perfect guide, not just an expert, but someone who has seen this world from both sides. Our guest today is Chengyi Ong, Head of Policy for APAC at Chainalysis, the world's leading blockchain intelligence platform. Before diving into crypto, she spent over a decade as a regulator with the Monetary Authority of Singapore. She's gone from making the rules to helping enforce them in the wild west of Web3. In this conversation, we'll explore what's hot in crypto crime this week, why Japan has become a surprising hotspot for scams and illicit activity, and how a company like Chainalysis actually keeps up with the sheer speed and complexity of a rapidly evolving ecosystem. It's a masterclass in the operational, regulatory, and human side of crypto security. Let's dive in.
Good afternoon, Chengyi. Welcome to the show. It's great to have you.
Thank you for having me. Happy to be here.
There's never a boring day in crypto crime. That's the interesting part of the job. So what is hot in crypto crime this week?
It's hot in crypto crime this week. We do a lot of research on trends in illicit activity within crypto. It's a rapidly evolving space, and we always have to have eyes on multiple different threats at the same time. Last year, we tracked about $41 billion US dollars worth of on-chain value transferred to known illicit addresses. That figure we expect to continue to grow as we identify more illicit addresses. What are some of the big bits of crypto crime that we're keeping our eye on there? The biggest chunk of that figure, that $41 billion figure, comprises transactions with a sanctions nexus. So either relating to a comprehensively sanctioned jurisdiction like Iran or North Korea, or a sanctioned entity. Besides sanctions, there are many other threats that we're monitoring closely, but I think a couple that I would just call out as being especially topical is firstly, of course, hacks and theft of crypto. Last year, we saw $2.2 billion US dollars worth of stolen value, and this year, in 2025, in the first half, almost hit that figure again with $2.17 billion US dollars worth of value stolen. Of course, a lot of that relates to one large centralized exchange, but there's a lot more texture to that space as well. And the other area that I can't go a single day without talking about is cyber-enabled fraud and scams. This is an issue in Japan. It's a broader scourge in the region and of concern, not just due to its human impact, but also intersections with organized crime, human trafficking, and regional security. There is a lot happening in the crypto crime space.
But while the individual events always change week on week, you draw out the bigger themes and the bigger buckets of activity that you group it underneath. Still fascinating work. You never know what happens when you get to the office or even before you get to the office.
We're pretty decentralized workforce. We're always at the office, so to speak.
So we'll drill into the hacks and the scams a little bit further, no doubt, but I wanted to talk about yourself and Chainalysis. My story with Chainalysis, when I took my first steps in crypto, was still in New York, 2015, 16-ish or so. So I've seen Chainalysis in a meetup. And if you put yourself back to 2015, where we have Bitcoin, we have maybe the first sprouts of Ethereum, but it was a pretty pristine environment still. And there's this guy, Jonathan, who's pitching some tracing stuff. And I'm like, what is going on? Good for Chainalysis was clearly a good business idea. But the environment today is so much different in terms of the number of chains and what you're tracking. How, as an organization, can you keep up with this?
That's a great question. I would approach that by thinking about fundamentally what Chainalysis does. We try to make the blockchain something users can navigate. We do this by joining raw blockchain data, on-chain data with off-chain intelligence so that we can understand when different addresses are controlled by the same entity. Is that an entity, an exchange, a darknet market, or another node like a cross-chain bridge? By putting together this information, we essentially create a map of the blockchain. As the blockchain ecosystem grows, as it becomes wider, as it becomes more complex, we've also got to build our capabilities to keep up with that. And we do that in a couple of different ways. The first is in terms of engineering capability. The first ingredient of what we do is on-chain data, and that requires us to be adept and agile in how we ingest blockchain data and how we put it into a format that can be easily queried. The first part of what we've done is invest a lot of resources into really rethinking how we build that data pipeline. I think we've made significant progress in that area. At the last count, we fully supported 23 blockchains, and we look to grow that number by the day. So that's the first aspect, the data engineering of it. The second part, or the second ingredient in what Chainalysis does, is that off-chain intelligence, right? Taking that information on which addresses pertain to a darknet market or are holding stolen funds, and taking that and then joining that up with the on-chain data that we have. And so we've also invested and continue to invest in ways that we can collect that data, both through our team of analysts, heuristics, and new technologies to scale data collection. The third thing we've done to keep up with the ecosystem is, as you mentioned, when we started 10 years ago, the use cases for crypto were also more limited. Accessibility was more limited. Liquidity was also more limited. And today, what we've got is a much broader kind of ecosystem. And the types of questions that people want to ask of that on-chain data have proliferated alongside the number of use cases. And so today, we've got regulators asking certain questions, central banks asking certain questions, banks and financial institutions asking certain questions, crypto exchanges and investigators. I think when we first started out, we had specific purpose-built applications tailored to specific use cases, whether that's compliance or whether that's investigations. And over time, what we've found is we need to create more flexibility for more sophisticated users to draw on our data set to create actionable insights. We've been working hard to build that data platform in a way that you can make more bespoke queries of it.
By the description you've just given, it sounds like the institutions are already here, right? Everybody's been always talking about once the institutions come in, but they're already a big part of what you're doing, it sounds.
If I think about this region, there is a great deal of institutional interest, but I would say it's still fairly early innings in terms of the institutions coming to town. There certainly is a lot of interest. If you take banks, for instance, there are a couple of early movers or industry leaders that have built a whole strategy around digital assets. But beyond that, most institutions moving into the space have done so in a more cautious and risk-bound way. They might start by banking crypto-native businesses and then considering how they will expand their suite, maybe think about custody before they think about stablecoin issuance. So it's really still a cautious journey. The institutions are here, but we're still at an early stage of how actively they will engage with crypto.
You've also experienced the traditional financial world as a regulator. With that, obviously, comes the question that you probably have answered more than 100 times is, what made you jump ship and go from being responsible for the financial stability for a whole country to, if you take a cynical view, you would say you're representing a private company now, and the outcomes that you want to achieve for that are maybe slightly different. You had a brilliant career, 13 years with the MAS and sometime at the IMF. What made you go into the private sector at the point you did?
To be honest, I was very happy at the MAS. I found the work really enriching and the people were amazing. I loved the sense of camaraderie and the mission that we had there. So it wasn't an easy decision to leave. One of the things that made me take that step was the feeling that technology was moving very quickly and that it could fundamentally transform financial services. The best way to understand what was happening was to be closer to the front line of it. When I did step out, it was a deliberate decision to join Chainalysis, specifically because of the mission-driven nature of it. So the mission of Chainalysis is to build trust in blockchains. Essentially what it does is to provide actionable intelligence, provide information to different decision makers that are looking to manage different types of risk. For me, there was not really a potential conflict of, well, I need to put Chainalysis before financial stability, because I guess the thesis here is that Chainalysis is not only aligned, but it's potentially necessary for financial stability, or at least on-chain data is necessary for financial stability if the space is going to grow. For me, stepping into Chainalysis was a way to tackle the same policy questions I would be asking in MAS, but just in a different way and with access to different parts of the ecosystem in a way that you don't necessarily always have when you're a regulator.
Arguably, the options are still there, right? If you wanted maybe to go back at some point and more into a regulatory role, you would be a better regulator for the experience that you have gained in the private sector.
I would hope that I would be a better regulator. I do think you need a little bit of a two-way flow between the private and the public sector, particularly in areas that are fast moving. There are real synergies. In the public sector, we did a lot of rigorous and in-depth analysis. I think you do need a little bit of two-way traffic between private and public sector, that cross-pollination of information, understanding of how businesses work, what the industry structure is, what motivates different players. All of that is really important for policy making. And then likewise, an understanding of the broader macro considerations, why certain risks have to be managed in certain ways. That's also useful information in the private sector.
Let's get back to the accent and the geography. You rightfully said Japan is the hotspot for all the hacks, not only in crypto, lots of phishing going on with the securities brokers, enormous amounts of illicit trading that happened on the markets with accounts that have been taken over. I have a perspective of why that suddenly happened. Is it just like because of Chainalysis and other players in the space, we actually know it happens now, and before it might have been going on, but nobody really had the transparency?
Oh, from my perspective, this is not really a crypto-specific issue. This is a broader issue of different types of cyber-enabled fraud and scams, from stealing credentials to authorized fraud, so things like romance scams, pig butchering scams, and so on. So I don't think this is a crypto-specific thing, and it's certainly not a Chainalysis-specific thing, but we have seen a structural change in that area. There have been a number of different threat analyses that have been done in this area, and essentially what they point to is the growing intersection of organized crime, professional money laundering services, cybercrime as a service, and this cyber-enabled scam activity. From Chainalysis perspective, we look at crypto and scams from a few different dimensions. We look at where you have scam proceeds that are directly paid in crypto, like high-yield investment scams, where you send your crypto and then it gets stolen. We also look at crypto as a laundering vector. This is directly a sort of a result of the speed, the accessibility, the functionality of crypto. And as the crypto market grows, crypto becomes more appealing as a laundering instrument. That's something we're looking at in the context of scams. And then we also, thirdly, look at crypto's role in the supply chain of scam operations. So essentially what we've seen is scam operators being able to get the goods and services they need to carry out their operations from a constellation of different vendors that provide specific things like deepfake software, seasoned social media accounts, web hosting infrastructure. A lot of the time, this is brokered by online marketplaces that can operate on the clear web. They can also operate through channels like Telegram. Because these goods are paid for in crypto, we can see the flows. We've seen the evolution of that scam tech ecosystem that lowers the barriers of entry. It increases the scalability of scam operations. And I think those structural trends are what is driving this global scamdemic.
You were just saying that's where we can see it. And if I was now a crypto criminal, would you actually advise me using crypto to move my funds? Because funds like yours make it transparent? And are they like in the traditional ways of laundering money with shell companies and companies that own companies, etc.? Are there better ways to ultimately do that, or do I need to take the Criminal 101 course again?
When you say again, I assume that means you've actually taken the Criminal 101 course at some point in time. I think, look, the transparency of the blockchain does create advantages for tracing and for investigation. That doesn't mean that criminals aren't abusing cryptocurrencies. And we clearly see that happening, right? And that again comes back to the fact that crypto can move seamlessly 24/7 at low cost and at very high speed across borders in a way that maybe cash can't. And so, like, I assume, not being a criminal and not having taken the Criminal 101 course, if you are looking to move illicit funds, you would be exploring a variety of vectors. It may not necessarily be a single one that is the only favorite.
And speed seems to be playing a big role here. As you said, being on 7x24 and being able to move funds, split them up, push them out into different channels and bring them together within literally seconds makes it so much harder for anybody who's trying to trace. This will take days, and by that time you might have at least gotten some of the funds converted and off-ramped to actually spend them in the real world. The bits and bytes flow so fast that the tools have a hard time even catching up with that.
I would say it's not necessarily an issue of the tools being able to catch up. I would say it's things like cross-border cooperation or collaboration between law enforcement, right? You can see in real time the funds flowing across different intermediary addresses, consolidation addresses to an offshore service. How quickly can you get information from that service? How quickly can you make a request to freeze or for KYC information? How quickly does that response come back? How effective is that process? I think you were absolutely right to highlight this issue of speed, because that really is, I think, where the investigative processes are eclipsed by just the speed of crypto. We need to invest in processes that allow us to not just have a real-time view of assets going across the blockchain, but also the ability to actually act on that.
Got it, thank you. Clearly also what we see with the scams is that investor protection is an important task for the regulator, in addition to financial stability. Clearly, simple things, low-hanging fruits that could have been done earlier have not been, and at least as far as Japan is concerned, like two-factor authentication and so on, have now moved at rapid speed, finally. So essentially forcing the customer to take these protective measures, where before maybe it was we let the customer decide, now we decide for the customer. But then at the same time, it feels like there, and I speak from a Japan perspective, there's quite some time between the rulemaking, which by itself already has a lead time, and the application of the rules in terms of actually players on the playing field and trying to adhere to the rules. And I think we've seen it repeatedly. We've seen crypto exchange regulation coming out in Japan first, and now we've got 12 million accounts across almost 30 crypto exchanges in Japan, while Coinbase has more than 10 times as many or so. You can't say that being early actually helped building, let's say, a world-class industry. We've seen the same with security tokens. I've seen with stable coins. Literally an hour before we got on the call, we finally got the press release from JPYC that they got the money transfer license. So they will be the first real quote-unquote stablecoin issuer here. But that's also been a year after the regulation came into being. These are indications that we're erring on the side of caution and putting quite a bit of emphasis on making sure that nobody gets harmed, while you could take another view that if you allowed a little bit more experimentation, or maybe also accepted that sometimes things go wrong, as long as you compensate for that monetarily, whoever got affected, then you could move a little faster. I try to did is very balanced and not blame the regulator in any way. But I think there's something in the ecosystem. If you make the rules quickly, you should also ensure that the players get on the field quickly to try out the rules. And there seems to be a gap.
I think you've been very balanced about that. You've brought up 2 points. One is an issue of risk appetite, and the second is an issue of implementation lag. I think risk appetite is going to be quite specific to each jurisdiction, where regulators choose to fall in terms of the balance of space for innovation and new business models versus protecting the public. In general, they are operating with investor protection as a core priority. The second issue that you've pointed out is that often after legislation has been passed to great fanfare, it takes quite a long time before the rules are implemented, before licenses are granted. It's not just in Japan, it is the case in other jurisdictions as well. The queue for digital payment token licenses in Singapore is a very commonly cited pain point within the industry. And that is a function of the legislative processes and supervisory capacity. Regulators are always balancing between how quickly to implement in order to offer the industry a transition time to get ready versus keeping that supervisory and regulatory momentum going. I don't think that's easy to balance, but across the crypto ecosystem, when we look at different jurisdictions, the amount of resources a supervisor has to process license applications, to get up to speed with what may be quite niche and esoteric business models, there is room to vastly increase that supervisory capacity. If we are able to do that, then that should theoretically help to reduce the time between legislation and regulation coming out and when the players get on the field. This is certainly an issue. There's a lot of publicity about the Genius Act and how it's finally been passed, and that's really great. But there is still a good deal of work that needs to be done before the act can actually take effect. We could be looking at 18 months down the road. This lag exists across all jurisdictions.
Now that you brought up the US, a year ago when we had the last WebX conference, I had a panel with Catherine Dowling from Bitwise. We had the Bitcoin ETF early in the year, and just 2 or 3 weeks before the conference, we got the Ethereum ETF as well. That was what crypto was in the US 1 year ago. And so I can't wait to see her again next week. There will be even a brighter smile. But it's also the way you described it. There's still lots that needs to get done. We still see them in Asia. Ultimately, they all build global businesses.
Nobody can resist Tokyo.
Tokyo is a popular place to come to. It's also still cheap, especially for US dollar people. Given that the US is already the biggest traditional capital market, now that they finally get their act together on crypto, that it's not be a full dominance, that Asia, other regions still have a chance to play a significant role, and maybe a more significant role, a larger share of the pie than we have in traditional financial markets.
Yeah, I think we're still in super early innings of the integration of blockchains into financial markets, into non-financial markets. And so certainly it's too early to prejudge what the weight of, say, Asian hubs will be in Europe vis-a-vis the US. A lot of that is also going to be shaped by broader dynamics, the geopolitical chessboard that we see today. Some of those political dynamics will spill over into financial markets and have a bearing on crypto markets. What's super interesting is the US has always been, based on our research, the largest single crypto market in the world by on-chain value received. And that's been the case even when you didn't have these tailwinds from the current US administration in place, even when the overall stance was still relatively hawkish, when the prospects for regulatory clarity were unclear. There was still a good amount of activity there because the capital is there, lots of projects are there. They've got the retail interest, they've got the institutional money. Everything in the US has scale, even in crypto. But if you think about where a lot of the use cases are emerging, innovation follows real world needs. A lot of the gaps in financial infrastructure are more pronounced in other parts of the world, whether that's to do with cross-border payments, the cost of remittances, whether that's to do with the depth of financial markets and the availability of investment products. And so that creates quite a fertile ground for organic adoption of crypto to meet real-world needs. Insofar as we are seeing that, I think that's a really interesting dynamic that we'll have to continue to look out for. The US is the traditional center of capital, but there's a lot of innovative stuff that could be happening outside of the US as well that's worth monitoring closely.
You alluded a little bit to the North-South divide as well. Now we get a Japanese yen-backed stablecoin, and the feeling is a bit, so what? It's not like I don't have 50 different flavors of points and 60 different payment service providers. By the way, also a real-time payment system that works pretty well. And so what does a stablecoin add to my life as a citizen of this country or resident? Not so much, but if you don't need to build a landline, you can go to the mobile phone straight. And so if you maybe don't have built out financial system, then yes, these new technologies could be very attractive in actually building the access to markets, even like to foreign currencies or stable currencies, etc.
Yeah, each market has its own pain points. There are jurisdictions in which domestic payment systems may not be so efficient, that are looking for some sort of digital money to speed up those payments. Even where domestic payment systems are efficient, there are often still challenges when it comes to the cross-border part of the picture. If you think about FX markets, there are inefficiencies there, particularly with regards to exotic pairs, that stable coins could potentially be interesting in terms of helping to solve. So that's the first way that I think about it. The second way is that it's not just about the low-hanging fruit, right? Stable coins, why they're interesting is not just because they could be an efficient payment instrument. They're interesting because they are a foundational component of an on-chain economy, if that's where you wanted to get to. They could be the base on which different types of innovative financial products are built. They could be necessary if you're thinking about tokenized real-world asset markets. And so if you're thinking of the bigger picture, that broader ecosystem, the stuff that is game-changing, then you need to make sure that the foundational components, the building blocks are right. For me, that's why this recent regulatory momentum around stablecoins is encouraging.
Oh, wait a second. I need to run out real quick and buy some additional Circle stock. If I have 10 years, I should be safe, right? With all volatility in between. Let's stick to the regional markets. In other conversations and podcasts, you called Japan a lighthouse regulation because it has been first in putting out these regulations, but clearly Hong Kong has been very active over the last 12, 18 months. Singapore seems a bit careful still. We shouldn't underestimate Korea. I think it was a changed government there. They're putting things into overdrive. So this is the established centers for Asia. And then you have India, Thailand, and Indonesia, maybe the markets with less developed traditional financial systems. But across these two layers, how do you see different emphasis on certain areas? And in a way, as you said earlier, it's a good thing that not everybody does exactly the same thing. So we have some level of experimentation. We can figure out what is actually best in the end and then maybe adjust. Which directions do you see things going in the regional side?
Super interesting question. The way that I think about it is you have a bucket of early mover jurisdictions, Japan leading the charge, of course, Singapore following close behind, and to a certain extent, Hong Kong, because it's moved very expeditiously over the last couple of years to make up for lost time. These jurisdictions have frameworks in place that they can now look to refine, whether that's making them more comprehensive, like in Hong Kong, or having a broader look at the treatment of crypto based on how it's being used, like in Japan. And so in these jurisdictions, that work will continue. Then there are jurisdictions that have been a little bit slower in bringing crypto regulation into force. And there, I think, is where the scrutiny is going to be. What we're seeing now is promising momentum in some of those areas. I know you've mentioned India, but what I'm excited about is Vietnam, because Vietnam has, for several years now, been consistently in our list of top 10 jurisdictions by grassroots adoption of crypto. They've been in the top 10 of our global crypto adoption index. But in Vietnam, until quite recently, the legal status of crypto even was unclear, and there was no regulatory framework around it, whether for AML purposes or for broader consumer protection and market conduct and prudential objectives. But we are seeing policymakers move fairly decisively in that direction, and that shift is quite interesting to me. So I think across the board, the commonality that we are seeing, whether in jurisdictions that are early movers or jurisdictions that are just starting to move, is a reconsideration of crypto markets, what risks they pose, what opportunities they offer, and what their relationship should be with traditional financial services. And I think that in itself is encouraging.
Vietnam is a place to watch. Thank you so much. Really appreciate that we could do this. Getting on the plane twice this week. So you're going to Bali and then you're coming to Tokyo. I'm really grateful that we could squeeze us in just before. See you next week in Tokyo then.
Thanks so much also for having me on to do this.